Well, good evening, ladies and gentlemen, and welcome back to Foundations of Stocks and Options Level 1. We are into Class 3 tonight, which means that we have made it to the basics of orders tonight. So we're going to talk about the basic stock orders and tie this in with what we started learning about in the last class, in class number 2. So that's how we're going to start, actually. We're going to do a quick review from class 2, and then we'll talk about both buy and sell orders, and then we will also deal with the issue of stop orders tonight. So let's get rolling here. I'm curious, did anybody have any trouble getting logged in this evening? My laptop is still trying to figure out how to get itself logged in. I'm not sure if it's just me, if it's just my laptop has decided to get slowed up here. Okay, so you guys all seem to be okay. Tom's struggling with audio, but the rest of you have audio, so okay. It's obviously it's my computer. Something's going on with it. So I will leave that machine. Actually, I think I'll just restart that computer. And, of course, as soon as I get it restarting, it logs right in. Go figure. All right. Anyway, so that's that. That was just my own personal challenges that has nothing to do with any of the rest of you. So today's class, we're going to do a quick review of Class 2. We're going to talk about buy and sell orders, and then we'll talk about stop orders. So let's get rolling here. As we review from last class, we talked about a very important subject in the last class, and that was the discussion centered around what is the present value of a stock. Would someone please remind me, what is the present value of a stock at any given time? In fact, we even went so far as to say that the present value of a stock is the same as the present value of a house or of any commodity or anything else that we can trade in the free market. And that is, as Leon has written in, whatever someone's willing to pay for it. Several of you wrote that in there, but whatever someone is willing to pay for it, you're absolutely correct. And so at any given time, we can sit here and we can come up with all the fundamental information we want to come up with. We can come up with all of our reasons as to why a stock should be trading at whichever value we think it should be trading at, but the present value at any given time is what someone is willing to pay for it, regardless of if that price is logical, regardless of if that price is rational, if they came to it for whatever reason. It doesn't really matter. The fact is, if that's all someone is willing to pay, that is the present value of that stock at that time. Now, with that information, we went a step further, and we did an entire discussion in the last class regarding fundamental pricing and how fundamentals are. What if I said fundamentals are blank? What would the word be? Fundamentals are factor theory. Fundamentals are, which one would you guys say it is? Factor theory. Fundamentals are theory, absolutely. I said fundamentals are theory, and which part is fact? What is fact is the price action that is actually occurring. And so we went into our discussion about what actually drives the real price of a stock, and we said it really ultimately comes down simply to what the buyers and sellers think about a stock, regardless of if that is rational or not. We simply can sum that up and call it trader sentiment. And then we went a step further and said, who are the buyers and the sellers? And we said the buyers and the sellers are people. And of course, people are predictable. And since people are predictable, we can use that price action to predict the future behavior of the stock. Not necessarily the future performance, but the future behavior. And we said the number one reason that people are predictable is because people are driven by emotion. We said there's two emotions that drive people. What are the two emotions that drive people in the market? Someone please tell me the two emotions. They are fear and optimism. Very good. Keith said fear and greed. Oh, Keith, you fell for it. Keith even fell for it still. Fear and greed. No, it's fear and optimism. And then we even went a step further and said that ultimately fear is really the driving force. It's the fear of loss of opportunity and fear of loss of capital. And whenever we get to the point where the fear is stronger than the optimism, then what's going to happen? The fear is going to win. And so because we're in this constant battle between fear and optimism, the fear of loss of capital or the optimism that this is our opportunity, because we're in that constant battle, it's a lot easier for the fear to flip over to the fear of loss of capital, and consequently panics and selling opportunities happen a lot faster than rallies. But when we get into the fear of loss of opportunity, what does that lead to? When the optimism, sorry, I kept saying opportunity. When the optimism builds to the point that the optimism turns from pure optimism to flat out fear of loss of opportunity, what does that lead to? Does that lead to a sell-off? No, that leads to a bubble, a irrational decision to drive the price of a stock to an irrationally high price. We saw this, well, we've seen this many times throughout history, but some of the more recent ones that we've seen, the tech bubble of the 1990s, the late 1990s, the housing bubble of the mid-2000s, and more recently, a lot of people feel like there's a lot of prices that have been in bubbles. I think it's a good argument to suggest that gold and silver were in a bubble back in 2009, 2010. Certainly, if you look at the price of gold and silver today relative to where we were just a few years ago, you would say just a few years ago we were in a bit of a gold bubble, right? Whenever you get to the point where the loss of opportunity is so strong, or the fear of loss of opportunity is so strong that it pushes the optimism beyond all rational components, then we get into a bubble type of a market. All right, so that sets us up for why price action works, and then we went from there into the discussion on emotionally driven buy and sell zones, or better said, we talked about support and resistance. Support being the price point where a stock finds more buying pressure than selling pressure. The buying pressure drives the price of the stock higher, creating a bullish situation. Resistance being the price point where a stock finds more selling pressure than buying pressure, and the selling pressure drives the price of the stock lower, thus creating a bearish situation. In the last class, we looked at an example of Caterpillar, and we had our resistance lines drawn in here around $88 a share, and we had our support lines drawn in here around $82 a share. And we said, it really doesn't matter why the stock finds buying pressure at 82. The reality is it finds buying pressure at 82. And it doesn't really matter why the stock finds selling pressure at 88. The reality is it finds selling pressure at 88. Consequently, the price of the stock goes down. Now, once we start to understand that the price action that we're seeing in the chart is a display of human emotion, and once we start to understand that human emotion is somewhat predictable, we start to recognize why price patterns become predictable to trade, and we're starting to build the foundation for why technical trading works. Now, let's go a step further tonight. We're going to get into the actual placing of the trade. So I'm going to start this discussion with a question of how many directions can the price of a stock go? Edmund, how many different directions can the price of a stock move? Most of you have already written in 3. I think that's probably going to be the common answer for most of you. Occasionally someone says 2. Occasionally someone says 4. I have yet to figure out the number 4. But 3 is the typical number that we say are the directions that the price of a stock can move. That is up, it is down, and it is sideways. So the price of a stock can move 3 directions, up, down, and sideways. What is your goal as a trader, Leon? Your goal is to pick a direction. If you can pick a direction, then what can we do next? Once we've picked the accurate direction, we can simply come behind it and apply an appropriate strategy. And so our goal now, we're starting to take shape of the theory here. We're going to analyze trading behavior. We're going to pick a direction. As we learn to pick the direction of the stock, we can apply the appropriate strategy. If we apply the appropriate strategy, then we become winners in terms of making money in the stock market, right? So understanding that our goal as a trader is to pick a direction and apply an appropriate strategy, we're going to use support and resistance to lay that framework. Support and resistance is going to help us lay the framework of where the buying pressure is going to be, where the selling pressure is going to be, so that we can pick a direction, and once we've picked a direction, now we're going to start to apply a winning strategy, okay? So for tonight's discussion, where we're going to move from here, that's a very introductory level discussion on price action, what we did in class 2. What we're going to do tonight is we're going to do an introductory discussion into strategy, buying and selling. And then in class 4, which will be coming up on, what is today? Tuesday. So coming up on Thursday night, we'll come back and we'll build more on our discussion as it relates to support and resistance, okay? But tonight I want to talk about how we make money when the stock goes up and how we make money when the stock goes down. So in doing this discussion, we're going to start with the 2 types of orders. There are 2 basic types of orders when we're dealing with stock. They are buy orders and sell orders. A buy order is an order to purchase a stock. as the name suggests. And as the name suggests, again, a sell order is an order to simply sell a stock. Now, there's two types of both of these, which we'll talk about later in the evening. You can have the buy to open a trade, and you can have a buy to close a trade. And you can also have a sell to open and a sell to close. That's where we get into the short trade. So we'll look at that in just a few minutes here. But as we talk about the two basic types of orders, when we buy, understand the flow of cash and understand the flow of shares. When we buy, shares come into our account and cash goes out. Shares come in, cash goes out. When we sell, shares go out and cash comes in. Now, why am I doing this part of the discussion? It's such a simple idea. Well, here's why. Because if you can understand the flow of shares and cash, we're understanding better what's happening with our balance sheet in terms of our account balance. Okay, so it's going to be a quick discussion here, but it helps gets everybody here on the same page. So when we start to talk about that, we want to answer the question of when do we buy and when do we sell? And we want to buy a stock when it's rising in price, and we want to sell a stock when it's moving lower in price. Very simple concepts here. You've often heard it said probably buy low, sell high, or some of you might have heard sell high, buy low. But the idea is that whenever a stock is moving higher, you want to be buying that stock. When the stock is moving lower, you want to be selling the stock. So if we came back over to our Caterpillar trade, when we're bouncing up off of support, this is when we're buying, and when we're pulling away from resistance, this is when we want to be selling our trades. All right, so that's your basic understanding of buying and selling. Now, let's dig into the two strategies that we can use with these two orders. There are two types of stock strategies that we can use. There's two orders, the buy and the sell order, and there are two basic strategies that we use, the long trade and the short trade. If we're long a stock, you own the company. You've purchased the stock. You buy it. And you want to use a long trade when you want to make a profit as the stock rises. In other words, a long trade is your most basic trade. You simply buy a stock. As the price of the stock goes up, you make money. The short trade is the exact opposite. And the easiest way to remember it is the opposite of long is short. Right? And so if the trade for a long trade is you want to buy the stock while the stock goes up, then a short trade is going to be the exact opposite. We are going to sell the stock as the stock goes down. We're going to short it. So we're going to use a short trade when you want to make a profit as the stock falls in price. The long trade is bullish. The short trade is bearish. All right, so let's dig into that a little bit further here. When we think about buying long, the long order is the traditional order. It's the traditional order that everybody's familiar with. Even Granny, who never traded a stock, understands the idea of buying a stock long. The idea is that you buy the stock, you own it. No one's going to take that away from you. You can hold it forever unless the company comes and, does a buyback or some sort. But as long as the company's in business, you're going to own the company unless you sell the stock. But they're not going to just take it away from you. So you can hold it forever. If there's dividends that are paid out, you receive those dividends. And since you own the company, you're an equity owner, you're a holder of equity. As the stock rises, that's when you're going to make money, so you need the stock to increase to make a profit. Let's do an example here. Let's go over to this trade. This was an Alaska Airlines trade it's actually a few years old now, but it was a trade that we had set up here in class. And so the idea here was that as the stock bottomed around support, we were finding solid support here around 14.50. And notice what was happening. We were running up into some resistance here around $18 a share. Well, so we can set a trade here. We can say if we break out of resistance, then we know that we've broken this pattern, and the idea is that the stock is probably going to be trading higher. So we put a little order in here that says if I trade above this green line, and we'll deal with the price points later, but let's just do this visually for this point. If we break above resistance, then we will buy the stock. Okay, well, sure enough, let's see what happens. Move it forward a couple days. We broke above resistance, and we can end up getting into this trade, all right? So we buy Alaska Airlines. All right, now, let's go buy ourselves 100 shares, and let's watch what happens on the balance sheet. Let's say we started our account with $20,000, and if we go out and buy 100 shares of Alaska Airlines at $18 a share, well, that's going to take $1,800 cash from our account, but that cash is not wasted. It just shifts over. Okay, so whenever you buy your shares, what's going to happen is the stock value now, or the equity value, will become $1,800 because you have $1,800 worth of Alaska Airlines, and your stock value is now $1,800. Your cash amount has diminished by $1,800 down to $18,200. Okay, so if you're looking in your balance sheet for your overall account, your cash or available cash to invest will have gone down, but your account positions will go up. All right, now let's watch what happens as the trade moves forward. As the trade moves forward, we have an opportunity. We could sell the trade when we get to our next resistance, which in this case is around $22 a share. Okay, so it only took us a few, maybe 5 or 10 days to get there, a couple of weeks to get to our next target here at $22, and that is one possibility of where we could exit the trade. If you want to exit the trade at that price point, I'm totally fine with that. It is a logical price point to get out of the trade. However, as we learn more about the trend following system, you're going to learn that just because we've hit your target, it doesn't mean you have to get out here. The other alternative would simply be to tighten your stop, which we'll talk about later tonight. You can tighten your stop order, and so your stop order goes up to maybe around $20, $21 or so, somewhere in here. And then that way, if the stock continues to rise, you can continue to participate. But if the stock turns around and starts to go down, then it will stop you out of the trade. All right, so let's see what happens if we use a stop order and we let the position hold. Well, sure enough, just a few weeks later, it took a couple of months to get there, but we continued rising. We had more exiting opportunities. I'll teach you later how we knew some of these others were exiting opportunities, but this trend continued all the way up until we hit our recent all-time high that had happened in January of 2009. And as we traded back up to this high around $30 a share, now it's a pretty obvious opportunity that it's time to get out of the trade, right? So you can get out at either price. I don't really particularly feel strongly about if you got out at $22 a share or if you decided to ride the entire trend. Depending on how you set your stop, I'm going to teach you several techniques for that moving forward. But depending on how you chose to set your stop, there are other places that you may have stopped out. You may have stopped out here around $26. If you stopped out at $26, you may have re-entered down here. Again, that's part of the trend following system that we'll look at later. But for now, let's just understand what happens to our balance sheet as we buy and sell the shares. Okay, so moving forward here, let's see what happens. We originally bought 100 shares of Alaska Airlines. That dropped our cash value to $18,200, but our equity increased to $1,800, and that brought our total account still to $20,000. But now watch what happened here. As the stock went on up to $30 a share, we decided to sell our 100 shares of Alaska Airlines. So we're bringing in now, we're going to add cash of $3,000. That's the sell of the 100 shares, okay? And we're going to take away the 100 shares position. So now we have zero equity. Our cash is now up to $21,200, which is also our total account value. Okay, so the reason I do this is I'm just trying to help you understand that as we buy shares of stock or options or whichever instruments you're choosing to trade, all we're doing is we're transferring cash from one column over to the next column. Now, there's a lot of benefits of buying long, obviously. And as we get into the various actual implementations of strategies, we'll play with that more and more. What I want you to understand right now, though, is all the kind of the theoretical, conceptual stuff about the buying process. So here's what you need to know. As we buy a stock long, when you initiate a buy order, it initiates a new long trade. Now, to undo that trade, how do we undo it? We're going to undo the trade by initiating a closing trade or a sell order that closes the long trade. Now, I'm emphasizing this because when we get to the short trade, it's backwards. So when we deal with a long trade, we're going to do a buy order to initiate the long trade, and we're going to do a sell order to close the long trade. And of course, the difference in the buy price and the sell price is going to be your profit. Now, I want to walk through one of these trades a little bit here. I'm doing this based on the request that I've had from our students to add this into our level 1 stuff here. So for those of you who are new, and this is kind of a review for you, again, I've added this stuff in here to help the students who are completely brand new. For those of you who are completely brand new, this is what you were asking for. So here we go. You can come into any broker that you choose to. They're all going to work basically the same. You've got a couple screenshots here on the screen. I'm going to basically walk through the Options House version. But if you're choosing to trade with Options Express, that's fine. In Options Express, in the main menu, you just come over to the Trade menu and come down to a stock order. If you're doing it in your virtual account, it's the same thing. It's the Trade menu. You come down to the stock order. In Options House, the platform looks exactly the same if it's virtual versus if it's a real money trade. The only difference is the color of the order form itself, and so you can determine if it's a virtual or a real trade, but the play itself is going to look exactly the same. So Options House is what I'm going to walk through here with us today. In Options House, whenever you select a new order ticket, let me show you how you did that here. In Options House, you're going to click down here on Order Ticket. Okay, and when you click on that button right there, it's going to pop up this next screen here where we can put an order in. Okay, so you're going to see up here at the top that it's the type of the order. And in this case, we're going to do, this is options, spreads, or stock. It's for all the same ones. Whichever broker you're working with, it's effectively going to be the same image or same variations of the same information. So you can just apply it to whoever you're working with. But what you're going to want to do is you're going to want to put your symbol in, your ticker symbol. So you just type in whichever ticker you're going to use. For example, if we wanted to trade the QQQ, we would type that in here. And then you're going to press the Go button, and that's going to pull up everything that you need, okay? So once in Options House, once you've pressed that, it fills out the rest of the information for you at that time. So you see we're buying a stock. The action is a buy action as opposed to the sell action. There's no expiration because we're dealing with stock. There's no strike price. There's no call or put because we're dealing with stock. The next form is how many shares you're dealing with. In this case, it's 100 because that's what I typed in there. And then the next item here is going to be your price type. We can have a limit order or we can have a market order. The market order is going to go in immediately at whichever price is being quoted, and it's going to be the best price that they can give you, but there's no guarantee. If you do a limit order, it's going to be limited to the price that you put in the limit box. And most of the time, what you're going to want to do is put a limit price of the asking price, or maybe a few pennies below that. In fast markets, I typically will use a market order. I will use a limit order in very slow markets if the spread, the bid-ask spread, is very, very wide. That's the only time I'll usually use a limit order. But if it's a small spread like you see here, or if it's a very fast market, I will tend to use a market order just so I can get the order filled. And then the next column here is the duration. In this case, it says day, so we know that this order is going to be good for this particular day. And by the end of the day, if it's not been filled, then that order is going to expire. All right, so you can sum up down here. You're going to see the order summary. Buy 100 shares of QQQ at a limit price of $63.18, duration for the day. And then this is how much money we're going to spend, $6,318 plus your commission. All right, next thing you're going to do is you're going to press preview, and this will just be a summary of the order before you place it. So the upper left corner, there's your summary. You're going to have a little message here that either says you can place the trade or you cannot place the trade. In the bottom left corner, you will see the impact of the order to your overall buying power. Okay, so in this case, the margin requirement for this is going to take off $1,579. Stock buying power will be reduced down. Our option buying power will be reduced down. Here's our total spend, $6,317 plus our $3.95 commission. There's your total, and you're going to hit place order. Once you hit place order, you will see the order in the order area waiting to be filled. Okay, so there's going to be, whichever broker you're using, there's going to be an area that says orders, and as long as it's waiting to be filled, it'll be an open order. And once it's actually filled, then the order will say filled right here, and it will show up on your balance sheet. You can look at the overall account balance up here, and you can see that the account still had $20,000 in it because we had not actually initiated the order yet. It's still pending. And the overall cash balance over here is $20,000. Once that order is filled, then the stock buying power will drop down, which actually it's already factored the buying power in there. But then you'll have the portfolio value right here will go up by the amount of the purchase that you just did. Okay, so that's how that will happen. Your cash balance will go down, your portfolio balance will go up, your account value will effectively stay the same. All right, that's how the order process goes in terms of a long trade. Now, let's talk about selling stock short. Whenever we sell stock short, shorting is the exact opposite of buying a stock long. Whenever we sell stock short, shorting is the opposite of buying long. What does that mean? It means to initiate the trade, we're going to sell the stock. Now, how can you sell the stock if you don't own the stock? Well, here's how we do it. We borrow it from the broker, and then we turn around and sell it. Now, the challenge is at some point, you got to come behind it and buy the stock. Okay, so in order to complete this trade, we're going to sell it first, and then we're going to buy it, which you notice is completely backwards from a long trade. And whenever you sell a stock short, you do not receive any dividends. On the contrary, you're actually responsible to pay any dividends that may be required at the time. And in order to make money with a short trade, you need the stock to go down to profit. Okay? Now, let's do a quick example here, and we'll talk more about why and when shorting would be appropriate. But let's just do a quick example. This was a Netflix trade. This was another trade we actually set up in class. This was back in 2011. Many of you may have actually watched Netflix do this roller coaster. It was great. There was a lot of reasons to believe that Netflix was turning into a bearish trade, but let's just go with what we got on the screen here. So if Netflix starts to reverse, it drops below our trend line here, we drop below our support level, then we're saying, well, this stock is reversing. We think it's going down. How do you make money with a bearish trade? You sell short. So we're going to sell short. Well, let's see what happened. Sure enough, a couple of days later, the stock breaks bearish here, and we sell short, and we're into a short trade now. It doesn't take too long before the stock runs down to a first level of support, bounces back up, tests the resistance, which is a very typical pattern. It sells off again, and there's two opportunities that we had to sell at a target point of about $200 down here. Okay, so let's see what happened to our account value. Now, this is going to be very interesting to you if you've never sold stock short. Watch this. So let's say that our account cash starting off was $41,200 starting off, okay? Well, when we go and we short 100 shares of Netflix, look at what happens. Our cash value goes up. Look over here on the right side, though. Our account value went from $41,200 to $41,200. It did not change. But the cash value did change, and in the number of shares, notice what happens. We now have a negative 100 shares at 245, and we have negative equity. So if you come down to the new balance over here, look what happened. Our cash balance has increased to $65,700. We have a negative share balance and a negative equity balance to give ourselves a total of basically the same account value that we had when we started. I'm showing you this example because so many people have historically misunderstood how the accounting goes for selling stock short. All we're doing when we sell stock short is taking a negative stock position while the stock falls in value. To do that, we're going to receive cash. We're going to borrow the shares. Here you see we've borrowed the shares, and we receive the cash up front. So our cash value goes up, but our number of shares is in a deficit. Now, let's go to our target. We end up buying to cover our position. Remember, we sold to open, so we're going to buy to cover or buy to close. We're going to cover with 100 shares of Netflix at $205. That's going to cost us $20,500. Now watch what happens. We add 100 shares because we just bought 100 shares. But remember, we were in a deficit. So adding 100 shares brings us back to zero. That brings in $20,000 in equity. Our account balance has now increased to $45,200. That's how the math works for a long trade and a short trade. That's why I wanted to walk through both of those for you to see both of those, okay? Do I have any questions about that? I'm going to talk about selling short in a little bit more detail here in a couple of slides, but do I have any questions about those components of how that math works? Because I know historically some people have been confused about that, and I'm trying to uncover the confusion. Gary wants to know why margin requirements Gary, I'm not sure what your question was. Can you type it again? It got cut off there. The realized gain on this was... Well, I didn't actually mark the realized gain, but it was about $4,000. Yeah, about $4,000, Robert. That is correct. Okay, the difference is the $45,200 versus the starting balance of $41,200. So we had a $4,000 gain overall. You are correct. Okay. All right. Let's. Wayne says accounting requirements for shorting. What is that question inside the question, Wayne? What are you trying to get to there? Gary wants to know why the margin requirements for buying stock. Gary, you have the choice. You don't have to, but you may choose to buy stock on margin. If you wish to do that, you can do so by putting up 50% of the value of the stock. Okay, Gary, so I had that account set up for a margin account, which means even though I needed to buy $6,000 worth of stock, I can do it for $3,000 cash. Because that is because that's an index ETF, they'll actually let you do that on a 4-to-1 basis, so you only have to put up 25%. That's where that margin came from. Okay? All right, let's talk a little bit more detail about selling short and kind of understand this a little bit more. This is one of those subjects that, in principle, it's really quite simple, but people get really confused about it. So I'm hoping that I can kind of unpack this and make it not as confusing for you tonight. When you sell short, you're short not because of any height issues. It all has to do with what you own versus what you don't own, or better said, you owe. You're short because you don't own the stock, you owe the stock. Realize whenever we looked at that balance sheet, what happened? We sold the shares short and our account equity position went to a negative stock position. That's because we borrowed those shares. You say, well, how can you possibly sell something you don't own? And the answer is we borrow it. You borrow shares you do not own from your broker, and then you sell those shares, and now you are in debt however many shares those are. Now, this sounds like a scary concept to a lot of people because most people are anti-debt and most people don't like the idea of some of the risks that are associated with selling stock short. And so a lot of people shy away from the short trade. In truth, the short trade is a very logical trade, and it's a trade that, frankly, has to occur in order for the free market to stay balanced. If we don't have short trading, the free market will get out of balance, and we would have runaway bubbles. That's what you really don't want. And you've seen this every time that governments get involved and they limit the amount of shorting that can take place. We always have irrational behavior that's surrounding that because without the short trade, it throws markets out of balance. So let's understand this a little bit. People say it seems wrong that you would be able to borrow shares that you don't own and sell them. People say it seems wrong that you would make money if someone else is losing money. You know, people come up with all sorts of ethical reasons. So let's just kind of unpack this and see if it's really justifiable. The first reason that it's legal is it's the rules of the game. Okay, anytime you play a game, there's going to be certain rules, right? You may not like the rules, but they are the rules. And typically, the rules are there for a reason. In this particular case, the rules are here for the reason of providing liquidity. Now, what does liquidity mean? Liquidity has to do with the ability to get in and get out of a trade. If nobody is there to be the other counterparty of the trade, then we're going to have low liquidity. In other words, there's no one to make the trade with you. So the market maker is constantly widening the spread and doing things to attract a counterparty that can make this market work. Well, what happens if, for example, there is no shorting? If there's no shorting, and let's say you're looking at a company like Apple, and Apple's just running up and up and up, and there's no risk because nobody's taking a short trade. All you need is for the company to keep going higher and higher. Everybody buys. There's no reason to sell because the stock never goes down. Well, what happens to the price of the stock? Eventually, the stock does this. And instead of seeing Apple go to, today we're in the $100 share range, but before the split, we were in the $700 range. And if we had not had shorting in the market, what would the price of Apple been? I don't know, possibly $5,000 or $7,000 or $8,000 a share, right? Because there's no limit to the risk. Nobody, I said that poorly, there's no counterparty to the risk. There's nobody to come along and say this stock is too expensive. So what happens with a short trade is whenever people are paying too much for a stock, someone can come up here and say, yeah, I'm going to short this thing. I'm going to provide liquidity. I'm bringing shares in here so that somebody else can buy them, and that also helps suppress the price. It keeps the free market a free market. It ensures a free market. If you do not have short trading, what happens is a runaway market where we end up with a bubble of bubbles. It would make the tech bubble of the late 1990s look very benign, frankly speaking. It would make, probably a better example, the housing market of the mid-2000s is a good example where, frankly, some shorting needed to happen. You don't typically short a house. And so, we ended up doing that where we had all these short sales of the house, but I'm getting a little bit more deep here. In principle, you don't have a whole lot of people that are coming in to short sell a house so that we can suppress the price of the house. You understand what I'm saying? And so what happens is people say, oh, housing prices always go up. People keep driving the price up. People are willing to pay more. And as the buyers are holding more and more real estate, thinking, well, prices are always going to go up, then the supply goes down, and that creates even more demand, and you get a big, big bubble, right? The same thing will happen in the world of stock if the short seller doesn't have the opportunity to come in and take that risk of the counter trade. So that's why shorting is a necessity in the market. Shorting is a true necessity. If we do not have it, we do not have a free market. We have a market that may or may not be rationally priced, and even with rational pricing, the buyers have no real incentive because they know that the counterparty doesn't have any real risk since the counterparty is not going to be a short trader. Okay, so shorting is a necessity in the world of trading. Let's just put it that way. Now, that brings us to the moral question. Is it morally correct? Should you be making money if someone else is losing money? And, I never thought about this until back around maybe 2010 or so. The market was turning bearish. If you guys remember that big dip that we had in 2010, and I had some family friends that I was talking to about their particular trades they were in, and I suggested they took some bearish trades. And the wife, she came back, she said, well, I can't do that. I can't make money while people are losing money. And I had never thought about that before. But as I dug a little bit deeper, it turned out a lot of people had that fear. They said, well, I don't want to make money when someone else is losing money. And as I thought through that, I said, well, why should that be wrong? You're not forcing someone to buy the stock. And if you're not forcing them to buy it, then they're going to go buy it anyway. The fact that you're shorting it, they have no way of knowing. Whoever the counterparty is, they don't know if you're selling it to close your position or if you're selling it to open a new short position. And so the counterparty has no way of knowing. All you're doing is playing the short side or playing the sell side of it. So I took this a little step further, and ironically, this is a true story. after I created this example with the iPad, I actually, like 2 or 3 weeks later, I got on an airplane and I sat next to somebody who did not know I was eavesdropping on their conversation, and this guy actually did the story I'm about to tell you here. So it's kind of ironic. But let's, how many of you guys remember when the iPads came out? The first ones, not the new ones, but the second generation, the iPad 2. If you remember when the iPad 2 came out, it was a huge craze. I mean, Apple has a gift for launching products and creating a lot of buzz. You remember that, Sandy? And so my buddy Josh and I, we went down to the mall. It just so happened that we were going for a different reason. We did not even realize the iPads were being released that day. But we got down there, and there was a line wrapped around the mall. I mean, it literally went all the way down the hallway, down to the food court, and it doubled back about halfway back up. And so as we were looking at this line, we're like, what was this line for? And then we kind of started putting two and two together, and we figured it out. These people were camping out waiting for the iPad because the Apple Store had closed for the day. They were going to open at 5 p.m. So these people have been waiting all day for the iPad to be released, right? In fact, there were people in line on their old iPad waiting for the new iPad. Well, you know they're not all going to be able to buy because they're going to run out. So we've got a huge demand, limited supply. What do you think happened after the Apple Store opened? Sandy, the doors open, people rush in, they buy all the iPads, and there is a bunch of people who don't get one. What do you think these people who don't get one are going to do, Sandy? They are going to do what every logical person would do. They got to get the iPad. I mean, they camped out all day. They go to the greatest free market in the world, Sandy. Where's that? They go to eBay. Of course. And so if you tracked this when this actually happened, people were going on eBay and they were paying anything for iPads. I mean, these things brand new were, maybe $700 or $800, and on the internet they were going for $2,000, $2,500, $3,000. It was crazy. So here's Peter. Peter is our little computer graphics guy here. He's a yellow guy. I don't know why they make these little people yellow, but they're kind of cute. You kind of do wish they'd draw a face on them from time to time. But anyway, so we got Peter here, and he's looking on the internet. And he's like, my goodness, these people will pay anything for an iPad if only what, Sandy? If only I had an iPad. What would you do with the iPad if you had one, Sandy? Well, of course, Peter would go put it on eBay and sell it. So turns out that Peter's friend Ted got one. Ted, I heard you got an iPad, and I know you're not going to be using it because you're giving it to your kid for his birthday. Do you mind if I borrow it? And Ted, being the good friend that he is, he says, sure, Peter, no problem. Just return it before my kid's birthday. We'll be good. Now Peter's got the iPad. What do you think he does? He rushes home, and Gary, he does exactly what you would do. He put it right on eBay, and he said, let's see how high this thing will run up. And there's William. William sees the iPad. He says, I'll pay anything. And he starts bidding, and so does Sarah and Robert and Dave and Jane and Pete and whoever else camped out overnight to try to get an iPad. And before you know it, they've run the price up. The auction closes. Boom. $2,000. So now they have paid too much for the iPad. Now, let's pause my story. How many of you agree that William paid too much for the iPad? You guys agree that William paid too much? Absolutely. He paid way more than market price. All he needs to do is wait a little bit, and he can go back to the Apple Store, and he can buy it for the fair price. But William was willing to pay too much. Now, here's the question. Whose fault is it? Is it Peter's fault that William is willing to pay too much? He was willing to pay too much, wasn't he? That's not Peter's fault. In fact, if Peter had not been there, along with a few other people who might have done the same thing that Peter did, how much do you think the iPad would have been? There would have been more demand for it. Who knows? Maybe the price would have gone to $2,500. Maybe it would have gone to $3,000, $3,500. These people were willing to pay whatever it takes, right? The same thing happens with our stock. Whenever you get into a market where people believe that a stock is worth buying regardless of the fair value, it creates a bubble. It's the exact same situation we've got with the iPad. People are paying $150, $200, $250 a share for a stock that maybe is only worth $100 a share. But because they have decided that they need to buy in, they've got the fear of loss of opportunity, they are willing to go make an irrational purchase and pay too much for a stock. How many of you follow the metaphor? What do you think Peter does after he sells the iPad? Well, first of all, let's look at his balance sheet. Peter's balance sheet started off with he had one iPad. Now he's got cash of $2,000. And when it comes to the iPad, he's missing one. He's short one. -1. Why is it a -1? Because he still owes the iPad. You see what's happened? All he's done is he sold the iPad for $2,000. He brings in $2,000 cash, but he's -1 iPad. It's missing because he sold it, aka he's short one iPad. He's missing an iPad. He sold it. What's Peter got to do to close this deal? Remember, he's not done. He made $2,000 cash, but it's not his, free and clear. He's got to go do what? He's got to go buy it back. Where's he going to do that? Well, hopefully he can go to Best Buy and do it. A couple weeks later, sure enough, they're in stock. Fantastic. He throws the iPad in his cart, and he's all happy. He buys the cover for $599. Fair market price. His profit is $1,401. What would have happened if Best Buy did not get the iPads back in stock, and if the Apple Store did not get them, and Ted's kid's birthday was coming up and Peter had to return the iPad? What would have happened then? Where would Peter have gone? He would have gone back to eBay, that's right. And how much do you think he might have had to pay? What if the night after he sold Ted's iPad that he borrowed, what if Peter heard the news that the factory burned down? They had a electrical fire, and now they're not going to be having new iPads for another 5 or 6 months. Yeah, Peter's messed up. He's going to have to go back to eBay, and now he's competing with those same people because Peter's desperate. He's got to cover his iPad. He's got to cover it so he doesn't, lose face with his buddy Ted. The same thing happens with stock. We'll talk about that when we talk about the risks of shorting. But let's bring this whole discussion over to the world of stock now. Peter was looking at the iPad and he said, people are paying too much. Do you think Peter could also look at Netflix in 2011 and think, people are paying too much? At that time, people were paying $257 a share for Netflix. Of course, 8 or 10 months later, Netflix had dropped to less than $100 a share. That's where that trade eventually went, if you're not familiar with it. But at this time, on this picture, Netflix was trading at $257 a share, and if Peter shorts it, he does the exact same thing. He looks at it and he says, my goodness, people are paying too much for Netflix. I don't know why. It doesn't matter why, but they're paying too much. So, hey, Ted, can I borrow some Netflix? Ted, my broker, I'm going to borrow some Netflix that you're holding, and I'm going to go short it. Broker says, sure, Peter, just be sure to return it. We put the whole thing out there. William's on the other end. Ooh, Netflix is running higher. I better buy some. It could be my big chance. Fear of loss of opportunity. Peter, that sucker, he was willing to buy my Netflix for $245 a share. Now, the truth is, Peter has no idea that William did the deal, but here's what happened on paper. Peter sold his Netflix for $245. He's now short 100 shares. As the stock falls, he goes and he buys to cover for $2.05, and that's where he made his $40 per share profit. It's the exact same process for shorting stock as what Peter did for his iPad deal. How many of you understand that? I realize for many of you, this is a foreign concept because it's not something you've let your brain really wrap itself around. But when you think through it, you realize this is a very logical trade. In reality, all shorting does is it takes the situation as it is. People are willing to pay too much. And the person who is a little bit of a opportunist can look at this and say, well, people are paying too much. I may as well sell it to them. May as well sell it to them. You guys have done this with houses. You've done this with cars. You've done this with other stuff. How many of you have ever had a collectible and you thought, I used to do this with baseball cards when I was a kid. Maybe some of you did it with baseball cards. You realize you've got these baseball cards and you thought the stars were pretty cool, but one day I realized that my Mark McGwire rookie card was worth something, and suddenly it was not worth nearly as much to me because other people thought it was worth something. And so I went down to the baseball card shop and I sold it. Some of you have done that with other collectibles. We do it with houses. We do it with cars. We do it with all sorts of stuff. When someone comes along and says, hey, people are willing to pay this much, and you're looking at that thing and you're saying, I wouldn't pay that much, so you sell it for that price. And you take advantage of it. Now, does that make you a bad person if the item then goes down in value? No. Someone was willing to pay for it. Why should you not sell it to them? That is the same principle of what's happening when we short a stock. When we short a stock, we borrow the stock, we borrow the shares by initiating a sell short order. The sell short order initiates a new trade. It is the opposite of a buy order. If your balance sheet is 0, and then you come along and you say, go sell 100 shares of Netflix, that is a sell short order. It initiates a new short trade. Now that you've initiated that new short trade, Dan, how are you going to get out of the trade? We got to close it somehow. To close the trade, you're always going to do the exact opposite. We're going to buy to close or buy to cover. Different brokers will call it different things. Usually it's buy to close or buy to cover. But when we issue a buy to cover, we are closing the short trade. The difference in the selling price and the buying price is your profit or your loss. Let's walk through the order together. Again, I'm going to do this in Options House, but the same process works for every broker that you will work with here. Okay, so whenever you come into your order form, you're going to have your ticker symbol. In this case, I did it with the spiders, SPY. We're doing stock, not options. The action is sell short. Now, in Options House, you just click that button right there where it says sell short, and it will toggle between buying and selling. Okay, if you're in Options Express, it's a drop-down menu. Some brokers, if it's a more professional platform, it will not say sell short. For some brokers, it will just say sell. And that's the way that a more professional platform will read it. It'll just be a buy or a sell order. And you're expected to know if you're selling to initiate or selling to close. Okay, so this is going to be a sell short order. There's no expiration because it's not an option, no strike price, no call or put because it's not an option. We're going to do 100. We're going to do a limit price. You could click on this and do a drop-down menu, and you'd have the option for the market orders and whatnot. Then we put our price point in there, which, again, we're going to take typically from the initial spread that we've got here. Remember, we're going to buy at the ask typically and sell at the bid, so the limit price will automatically propagate at the bid price most of the time. And then we're going to put a duration on here of a day order. All right, now you can read down here the order summary. You can read the estimated cost of the trade. And then we're going to click on preview the order. All right. Can you guys hear that helicopter that just flew over? I'm burning up, so I have my window open and a helicopter just flew over. I have no idea if that came through the microphone. If it did, my apologies. I think they're coming to look for me finally. Okay, you guys couldn't hear it? Okay, great. All right, once you click on preview order, you can preview it. It's just like the buy order, but here you're going to notice the order summary, sell 100 spider stock at the market price. Oh, I changed that to market at some point in there. Duration day, here's your order message. You're able to place this trade within the given parameters. If you don't have the money, it's going to say you can't do it. And then here's your margin. Now, notice your margin requirements. They're going to change here. You're going to have some margin required. Even though you're bringing cash in, it's going to require that you have some margin there, okay? We're going to, look what happens. Because we're selling, we're going to receive $13,535 because we're selling 100 shares. So this cash is coming into our account, and the total that we're going to receive is $13,531. Now watch what happens. We're going to press the place order, and look what happens after it's filled. I did the market order so it would be filled immediately. Excuse me. The status says it has been filled. You see that? And look up here. Our cash balance has gone up. We now have $27,000 in cash. Our account value, though, is still $20,000. And look at our portfolio value. Our portfolio value is in the negative. Why? Because we have all these short positions. So we owe some stock. So the portfolio value looks like it's a negative value. The cash value looks like you have too much cash. And the account value is about where you started. You see how that starts to work? Okay. Now let's sum some of this stuff up for you. Buying long versus selling short. When we're long, we own the stock. When we sell short, we borrow it. They're exactly opposites. When we're long, you can hold it as long as you want to. When you're short, you must return the shares. Now, people say, when do you have? Technically, there's no time stamp. It doesn't expire. You know, it's not like they say, well, you have to have them back by the third Friday. That would be what we do with an option. But when you're short stock, there's no specific time you have to return the shares, but as long as you're short, you're going to be paying some interest. Okay, it's not outrageous interest by most standards. If you were short for, say, 2 years, it would start to look a whole lot like a very expensive mortgage. But if you're short for, 3 or 4 weeks at a time, it's not going to seem like it's that much interest, and you'll be able to overcome that with the profit of the trade. So you do need to return the shares at some point. There's no specific time of when you have to cover, but you do need to cover at some point. All right, if you're long, you receive dividends. If you're short, you owe the dividends. You're going to be responsible to fork out the money for those dividends if you're short. Now, you can avoid that by not being short over dividends, but if they pay out dividends while you're short, you're going to be responsible for them. If you're long, you want the stock to go up. It's a bullish trade. If you're short, you want the stock to go down. It's a bearish trade. Do I have any question about long versus short or the order forms involved? If so, this would be a really great time to ask those questions. If not, I'm going to drink some water here, and I'm going to continue with the trade setup portion now that we've been through the order portion. No questions, it looks like. Gary says, so you should not short during dividend times. It's not typically the best idea, Gary. It really depends, though. I mean, the truth is, if, let's say, you're expecting the trade to drop by 10 or 15%, you may be fine paying out a 0.5% dividend. You just, you can factor that in. You just need to know, Gary, that if